Dutch Bros is a fast-growing coffee company, but is this stock a buy right now? Welcome to the Food Fund. Can Dutch Bros continue its glorious outperformance? If you own Dutch Bros or you're thinking about it, you need to watch this video. Let's start with the price action. Over the last year, you're looking at a beautiful 103% CAGR. Zoom out to 5 years, and it's a 15% CAGR. The company had a little trouble after IPO, but has since been a juggernaut. Market share is a key factor for food and restaurant companies. The dashboard shows Dutch Bros is the 5th smallest fast food restaurant company, but it is growing quickly. Looking closer, they have a 0.18% share of the market among public food, beverage, and restaurant stocks. Over the last 5 years, Dutch Bros' market share has actually compounded at an astonishing 31%. They've gone from 0.069% in 2021 to 0.177% today. That trend is gorgeous. I absolutely love this company's growth. They are literally stealing market share from their competitors. Let's look at the fundamentals for more. Gross margin is 27%. Not bad for a new and quickly growing restaurant company. Revenue has grown at a 36% CAGR over the past 5 years, now at $1.45 billion. No slowdown detected here. The cash flow also looks great. Operating cash flow increased at a 42% CAGR, CapEx worsened at a 16% CAGR. The result? Free cash flow has flipped from negative to positive, and that trend doesn't seem to be slowing at all. In fact, the pullback in CapEx spend since 2023 tells me that we should expect even faster free cash flow growth in the quarters ahead. Weighted average shares outstanding have increased over time, going from 45.9 million shares in 2021 to 119.5 million shares most recently. Dutch Bros is diluting shareholders pretty aggressively. Hopefully management starts to use some of that free cash flow to buy back shares and stop the rapid dilution. Next, return on invested capital. This tells us how efficiently management has used capital from investors. Going from minus 26.8% in 2021 to 4.5% most recently, management has clearly done a great job. I would expect this value to rise further. For operational efficiency measured by the cash conversion cycle, Dutch Bros is doing okay. It went from 9 days to 5 days. Management is slowly improving the efficiency here. Finally, debt. Net debt to EBITDA has risen from minus 1.5 in 2021 to 2.9 most recently. Dutch Bros was previously unprofitable, so this change in values means that the company turned a profit and has been paying down its debt since. Now, let's compare Dutch Bros' performance against the gold standard, the S&P 500. Investing $10,000 in Dutch Bros would have grown the investment to $11,642, compared to $13,991 in the S&P 500. That's an annualized return of 4.3% for Dutch Bros versus 9.8% for the S&P 500. Dutch Bros also showed much higher volatility, nearly 4 times higher than the S&P 500. Risk-adjusted returns, as measured by the Sharpe and Sortino ratios, were worse for Dutch Bros. Investors were better off owning the S&P 500 instead of Dutch Bros, but I think this will reverse over time. Dutch Bros was founded in 1992 by 2 brothers who pivoted their family's dairy farm business to selling coffee. The company quickly gained a loyal following for its handcrafted specialty coffees, smoothies, freezes, and its signature Blue Rebel energy drinks. Today, the company employs around 26,000 people and recently moved its headquarters to Arizona. Despite all of its growth, Dutch Bros does have some issues. Based on my proprietary scoring system, I give Dutch Bros a 5 out of 10. Still, I expect Dutch Bros to continue to improve and generate strong gains for many years to come. Before I share my final thoughts on that, if this analysis was helpful, please hit that like button to let YouTube know. It really helps the channel. And if you want more deep dives into food, beverage, and restaurant stocks, subscribe and ring the notification bell so you don't miss the next video. Your support means the world to the Food Fund. Also, don't forget to turn on your notifications if you are watching on a mobile device. So my final thoughts on Dutch Bros. Let's write it out in the spreadsheet. It is a restaurant company with a gross margin of 27%. The 5-year revenue per share CAGR is 3%, and the 5-year free cash flow per share CAGR is 40%. Though the margins are good, shareholder dilution is hurting otherwise strong growth. A return on invested capital of 5% is low but improving. Next, the cash conversion cycle of 5 days is not bad but could be better. A net debt to EBITDA of 5.2 means that it would take Dutch Bros over 5 years of earnings to pay down their debt. That is a much larger debt load than I would like to see. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, is 4.1, indicating that Dutch Bros is overvalued relative to its expected earnings. Dutch Bros is a fast-growing, super popular coffee company. Despite the headwinds many other restaurants are facing, Dutch Bros managed to grow same-store sales. CEO Christine Barone shares more in an interview on CNBC.
Yeah, thanks so much, Kate. So we did have a great quarter, and our customers clearly came to us. So our same-shop sales were up 6.1% for the quarter. We also had that was really driven by traffic growth. So transactions, our customers came back. That was up 3.7%. And as far as what's going on, I think what the customer wants today is they want an awesome beverage and they also want an awesome experience. And I think our teams are just doing an incredible job of delivering on both of those things.
Clearly, Dutch Bros is doing something right whilst competitors continue to be challenged. I love this company and I'm looking to buy the stock on any big pullbacks. Hopefully we have some red days ahead, because if we do, I'm gonna buy so freaking hard. What do you think about Dutch Bros? Are you an investor? Share your thoughts in the comments below. I always love hearing from you. Check out some more videos right now, and remember to put your money where your mouth is.